Time now to spotlight the bond market and beyond. Joining us for insight, we've got Andrew Brenner, head of international fixed income securities at Nat Alliance Securities. All right, Andrew, let's start out with the volatility that we've been seeing and the selling pressure we've been seeing in the bond market, especially in the way you characterize it. You said bond market's in trouble. Quote, this is not what we signed up for. What do you mean by that?
Well, first of all, as far as the bond market's in trouble, I mean, yesterday morning at the lows yields, the 30-year bond was 432. Last night, it hit 502. I mean, that's a 70 basis point move in a matter of 28, 32 hours, something like that. So, what we've had is, one of the things that the president wanted was lower long-term interest rates, and we're not getting those. And, and now, the 10-year backed up to over 450 last night. Now it's back around 440, and we have a 10-year auction today and a 30-year auction today. What I talk about is what we signed up for is, look, tariffs make, pushing back on tariffs make all the sense in the world. We like what the president's doing, but it's gotten out of hand. And, if you're going to try and save $1 trillion of export-import, negativity, and you're going to lose 6 to 7 trillion in equity markets and another 3 trillion in bond markets, it doesn't make sense. You know what? I don't want these jobs. I don't want, what are we going to do? We're already at 4.1, 4.2% unemployment. So we're at full employment. Where are we going to get the extra workers? Immigration. Well, immigration door's been shut. So all you're going to do is raise labor prices. And you know what? I watched a Morgan Stanley video about robotics, and it just struck me as all of the next bunch of jobs are going to be given to robots and not people. So what? I don't want this.
I understand that. Let's unpack a little bit about the stress that we're seeing in the bond market. Sure. Is a lot of it about systemic stress right now, and is there also concerns about liquidity?
There's absolutely concerns about liquidity, and there is stress. What you have here, as I just said to you a moment ago, you have a semi-Liz Truss moment, which happened in the UK, where you have a huge backup in yields. And it also reminds me a little bit, and a lot of people don't remember the name, but long-term capital.
LTC, where you I forget the exact,
where in 1998 you had a lot of PhDs that had all kinds of trades on that they thought were hedged, and they weren't, and you had unexpected consequences, and that's what you're having in the bond market now. And the PhD here is Navarro with his tariff experiment, and it just doesn't make sense to me. You've lost way too much money for what you could potentially gain. And at the end of the day, Trump is going to be judged the way that he knows he's going to be judged, which is how is the equity market doing? And right now, he's getting a D- in his first term.
Yeah, I mean, look, he tried to put out there was a social media post that was put out, and then you saw the equity market turn positive, and then we flipped again. Now it looks like we're flipping again. So it seems like, everything's spinning on a dime. But let's talk a little bit about, go ahead.
Diane, on Monday morning or Sunday night when you opened up, I mean, the S&P was down from the top 22.5%. That's a clear bear market. The NASDAQ 27.5%. So you've bounced a little off of that, but you're still down tremendously with a huge amount of losses. That's not what we want. Sure, a little bit of pain, but I don't see where the gain is going to be coming.
Does it feel like there's essentially some bottom fishing happening right now and investors searching for the bottom?
There is some stability in bonds right now. What I really think is I think you need a three-leg process where Besant, Powell, and someone else of major stature, maybe a Jamie Dimon who was talking today, or maybe a Brian Moynihan, say, look, everything is okay.
Well, Jamie Dimon didn't say that today. He said, look, there's risk of a recession in his interview on Fox Business.
Recession is I don't agree with it, but the recession is okay. But I just need to know that the bond market is operating normally, and it's not right now.
Okay. So let me ask you a question, because you have some concerns about the auctions today, and then we had a weak auction yesterday. So with the, we've got the 10-year and the 30-year today, as you mentioned.
10-year today, 30-year
tomorrow. Okay. So what, if there is weakness or if it's failed, what does that signal about the confidence in U.S. debt to you?
It's a problem. I think at the end of the day that there are enough buyers in the U.S. that they can sustain that, but the foreign buyers are on strike. I mean, there's just too much risk going on.
Okay, and is the bond market being moved more by, like, what is triggering the moves right now?
Deleveraging.
Okay.
Deleveraging from hedge funds, deleveraging from basis trades, delevering from bank balance sheets. It's all happening at the same time. The banks are concerned because they started to get a little bit more in treasuries because they felt that the SLR, supplemental leverage ratio, was going to change to their favor. And now they've started to reverse that, and they've gone into swaps in order to get their balance sheets down. And the swap market has gone crazy. It's out, 30-year swaps are out 20 basis points in the last few days. That's crazy. We've never seen that kind of move in the 30 years I've been doing this. Then you have the hedge funds, which have a lot of the basis risk on, and those basis risks are such minute profits that they leverage it as much as 100 to 1. And so now you've had that kind of unwind. And that's why the long end of the Treasury market has been so severely hit. Now the question is, will buyers step in today? And if you look to foreign buyers,
yeah. No.
Maybe
there's not much of an incentive.
Well, there is an incentive on a yield basis, but people just don't know where you're going to go next. And there's a little anti-American sentiment going on.
That's
because
what I mean
every
about there's
country
not
is
much
being
incentive.
tariffed. Yeah, but you know what? Last night in Japan, it was no different. They had a 40-year auction, and it went horribly. It backed up 32 basis points. So it's not just the U.S. It's all bond markets of the world are under concern.
You mentioned the Fed earlier. What levers would you want to see the Fed pull?
The Fed's in a very precarious position because inflation, even though we think it's coming down, hasn't shown up yet. And we have what's today, Wednesday? So we have CPI tomorrow. So we'll see that. But CPI, again, is very backward looking. So half the Fed is very fearful of inflation, and they do not want to ease. The other half is very concerned about unemployment, which they see rising, even though the hard numbers that they saw last week on the non-farm payroll look pretty decent. But I think going forward, it's going to be much worse. And if you look at the WIRP, World Interest Rate Probabilities, you've got about a 60-40 chance of a May cut. You've got probably a 160% chance of maybe a June cut. And and it goes on to the point of 4 cuts. Now we've said all along, even when it was 2 cuts, it's going to be 3, and we're going to stay with 3 cuts.
Andrew, I want to get your quick thought on the price action that we're seeing in crude oil. It is right now around $57 a barrel. It has been buckling today. It is off the lows of the session. From your point of view, do you agree with the views that essentially the way it's trading is as if there's risk of a recession?
Absolutely, there's no question. Now, we don't see a recession, but the oil market does right now. They're very concerned. Plus, I believe OPEC raised their production limits too at probably the absolute wrong time. So you're going to do it, and that's going to be great for inflation, and I hope it opens up the eyes of the Fed to be able to ease more quickly and not wait till they see the hard data or the white of the eyes or whatever of which to move. They have to be forward looking. And this Fed, last year they were a little bit forward looking, and I think that was good, but so far this year they've been very stubborn.
Okay, we will certainly see where they proceed next. And I know the odds have been increasing of more rate cuts this year. Thank you, Andrew. All right, that's Andrew Brenner, head of international fixed income at NatAlliance Securities. Thank you so much.